This video is brought to you by Kraken. Sign up today with the link below to get started trading and building your portfolio. Kraken's tools make it easier to custody, trade, and grow your crypto holdings safely. Links in the description. Private equity funds are not some exclusivity badge for billionaires. They're a real institutional toolkit that lets investors pool capital, deploy it at scale, and transact with banks and lenders on professional terms. If you want to understand how fund structures work, why banks prefer them, and the legitimate ways seasoned buyers acquire companies with little upfront cash, this video breaks it down step by step. Think of this as a practical compliance-first playbook for operating at scale. Let's start with the architecture. A private equity fund is essentially a pooled investment vehicle that buys assets, companies, real estate, or growth opportunities. Two parties matter. The limited partners, LPs, and the general partner, GP, LPs, are the capital providers. Passive investors who commit money but don't manage the fund. The GP is the manager, the professional team sourcing deals, negotiating terms, and executing exits. That governance split, capital on one side, operators on the other, is why institutions take funds seriously. Clear responsibilities, documented rules, and professional oversight. From a bank or custodian's viewpoint, well-structured funds create a commercial paper trail. You'll have a subscription agreement, a limited partnership agreement, LPA, a private placement memorandum, PPM, audited financials, and often an independent administrator. These documents explain how capital flows, how management fees are charged, how carried interest works, and when investors get distributions. That level of documentation helps banks satisfy KYC/AML and economic substance checks, which in turn makes it feasible to open accounts, move larger balances, and finance transactions. Tax and legal form matter, and they're complex. Many partnership vehicles are fiscally transparent. The fund itself doesn't pay corporate tax. Earnings pass through to investors who report in their jurisdictions. That can be tax efficient for some investors, but it's not automatic. Residency rules, withholding taxes, and local reporting obligations can create surprising liabilities. This is why a deliberate tax and legal strategy is essential. Retain counsel and an accountant who understand cross-border treaties, withholding rules, and substance requirements so you don't accidentally trigger a costly tax event. Now, how do professionals acquire businesses with minimal upfront capital? There are well-established legal mechanisms that experienced buyers use regularly. Seller financing. The seller accepts deferred payments or a promissory note, allowing the buyer to pay over time. That aligns incentives and reduces initial capital needs. Earnouts. Part of the price is contingent on future performance metrics, revenue, EBITDA, or other KPIs, protecting the buyer and keeping sellers engaged. Leveraged finance/asset-based lending. Banks lend against inventory, receivables, equipment, and forecasted cash flow. Lenders will demand conservative covenants, collateral, and rigorous reporting. Co-investment. Bring in partners or investors to share equity and reduce the amount you must commit up front. None of this is magic. These are structured finance solutions that depend on realistic underwriting and solid legal documents. If projected cash flow can't cover debt service plus seller payouts, the deal won't work. That's why due diligence, forensic financial review, vendor and customer checks, legal examinations of leases and contracts is the decisive factor in a successful buyout. Keeping the seller involved after closing often preserves value. Founders who remain as managers or advisors help maintain customer relationships and operational continuity, which reduces integration risk and increases the likelihood the asset hits projections. Complexity and structure can be useful, but complexity must earn its keep. Tax efficiency, operational clarity, or investor protection, not opacity. Paperwork is everything. The LPA and PPM are your constitution, investment mandate, management fees, distribution waterfalls, carried interest, liquidity timelines, transfer restrictions, the rules that govern behavior. Draft these documents to withstand legal and investor scrutiny. Ambiguity kills deals, clarity attracts institutional counterparties, and simplifies banking relationships. Risk management, stress test the model. Model scenarios where revenue drops 20% or 40%. Test interest coverage ratios. Build covenants with realistic cure periods. Use escrows and indemnities to cover unknown liabilities. Standard mitigants include insurance, earnouts, holdbacks, and escrowed seller reps and warranties. Finally, compliance and substance. If you operate cross-border, engage local counsel early, register where required, and implement AML KYC processes that satisfy banks. A well-run fund usually has audited statements, an independent administrator, and documented economic substance. These are cost centers that unlock institutional capital. To recap, private equity is a flexible vehicle to scale investments and access institutional relationships, but it must be used responsibly. You can structure acquisitions with limited upfront equity using seller financing, earnouts, asset-based lending, and co-investment, provided your underwriting is conservative, your documentation is airtight, and you have tax and legal advisors at the table.